Welcome to Investing Insights. I'm your host, Ivana Hampton. A distribution from your traditional IRA could cost you if you're not aware of your responsibilities. Many investors are saving up for their retirement in workplace accounts like 401ks, and those administrators handle tasks that IRA custodians don't. And it's up to you to take charge and keep track of your hard-earned money so you're not taxed twice. Denise Appleby is known as the IRA Whisperer. The Morningstar contributor has written about how to protect your IRA from costly mistakes. Welcome back to the podcast, Denise.
Oh, so great to be here. Thanks for having me. Happy New Year. Can we still say that?
We can. Happy New Year. Let's start with a quick explainer. What is a traditional IRA and how can someone fund their account?
Okay, so a traditional IRA, IRA stands for Individual Retirement Account. It's a retirement savings vehicle that you can set up yourself. Because, some of them like 401ks, your employer can set it up, but you can set up your own IRA. And if you have eligible compensation, you can make regular contributions to your traditional IRA. You can roll over amounts from employer plans to your traditional IRA. You got to make sure, though, that the amounts that you put into your IRA as a regular contribution does not exceed the statutory limits, because if it does, then you're going to have what is referred to as an excess contribution, which is going to be subject to a 6% excise tax for every year it stays in your account past the required correction date.
Now, there are situations when a traditional IRA can hold pre-tax and after-tax money. If someone has both in their account and withdraws money, how is the cash distributed?
Generally speaking, and you're going to hear me say generally a lot because there is always exceptions to the rule, but generally speaking, say 20% of your IRA balance is attributed to after tax, then your distribution will include 20% after tax and 80% pre-tax. Now, here's the problem, though. Many individuals forget that they have after-tax amounts in their traditional IRA. And so the question becomes, well, where did this after-tax amount come from, right? If you make a traditional IRA contribution and you didn't claim a deduction for it, either because you don't want to or because you're not eligible to, that creates basis, otherwise known as after-tax. After-tax amounts also can come from an employer plan, like a 401k or a 403b, and you roll that into your traditional IRA. By the way, don't do that anymore. Do that directly to your Roth, so you get a tax-free Roth conversion. But I digress. But that's just to respond to your question of where does after-tax amounts come from? Now, here's the problem, Ivana. Many individuals are taking distributions where a portion of it should be tax-free due to it being attributable to after-tax amounts. But the person who's doing their tax return is not aware that they have these after-tax amounts because they didn't tell their tax preparer, or for previous years where they have made these after-tax contributions and rollover after-tax amounts, no one kept track of those amounts. And the problem is when the IRA custodian reports your distribution from your traditional IRA, typically they're going to report the entire amount as being taxable, but they're going to check that little box that says taxable amount not determined. And that is a wink, wink to your tax preparer to say, listen, we don't know if it's fully taxable or not. We have to say it probably is. Then we got to check that box. And so the question becomes, why doesn't my custodian know this? That's because your IRA is the tax treatment of your IRA is determined on an aggregate basis, right? So if you have an IRA here, an IRA there, a traditional, a SEP, simple IRA, they're all aggregated and treated as one. So your custodian doesn't know if you made non-deductible contributions to this IRA or that IRA. And even if you have all your IRAs with that custodian, they don't know how you treat it on your tax return. So they have no way of telling how much is taxable or not. So you got to make sure you communicate that to your tax preparer.
And let's stick with the IRA custodian because, the the IRA custodian or the brokerage, they're going to make that distribution, but their responsibilities are a bit different from the 401k administrator when it comes to tracking after-tax dollars, as you were talking about. Can you explain what else should people be aware of when they're transitioning from a 401k administrator to an IRA custodian?
Absolutely. So typically, the administrator of a 401k plan is required to track how much is after tax, how much is pre-tax, how much is Roth, so that when you get your account statement, you can clearly see how much is pre-tax and how much is not. Now, they can do that because everything happens under their purview, right? Everything that comes in, everything that goes out, they have to track those as the administrator of the plan. And that only applies to one particular plan. So if you work for company A and company B, each stands on its own. Whereas with your IRAs, they're all aggregated and treated as one, because do you know who is the administrator for your IRA? You. So you're responsible for making sure that you don't pay taxes twice on that amount. Now, I'm so glad you asked that question, because here's a tip. When you're ready to take a distribution from your 401k, ask the plan administrator for a copy of your statement. You want the most recent statement. You're going to look at that statement, and one of the things you're looking for is, do I have any after-tax balance in my 401k? And if you do, say to your plan administrator, I want a split distribution. Send my pre-tax amount to my traditional IRA, assuming that you want a non-taxable transaction. Send my pre-tax amount to my traditional IRA and send my after-tax amount to my Roth. Now, they might say, we're not doing 2 direct rollovers. We don't have time for that. And then you say, okay, send the pre-tax amount to my traditional IRA, send the after-tax amount to me. And then I will roll it over to my Roth IRA within 60 days. Why am I saying you should roll it to your Roth IRA? Because there's a big debate about whether or not someone should do a Roth conversion. And we know, ideally, you want to do an analysis, a suitability analysis, to determine if a Roth is right for you. But when it comes to your after-tax amount, there's no debate. Roll your after-tax amount to your Roth IRA. That's a tax-free Roth conversion. No question. Everybody wants that. Put after-tax money in their Roth IRA, where it's going to grow tax-deferred and eventually become tax-free.
That was a great tip. So you brought up the 1099-Rs, and I want to get into it a bit more. What should retirees and other folks pay attention to when they start receiving those 1099-Rs from their IRA custodian?
Yeah. So, and we're talking about regular distributions here, because when we talk about return of excess, etc., it's a little bit different, right? So we're talking about everyday distributions. You get your 1099-R. In box 1, it's going to show how much you took out. In box 2, it's going to show you how much is taxable, box 2A. And, as I said before, the custodian is going to say, oh, all of this is taxable. But if you made after-tax contributions to your traditional IRA, whether it's the one with the custodian that you're taking the distribution from, or any other traditional SEP or simple IRA, then a portion of that distribution is non-taxable, right? Which is why I said earlier, they check that box that says taxable amount not determined. How do you compute that? Your tax preparer should have filed IRS Form 8606 for every non-deductible contribution that you make and every distribution that you take for that year and after, because all of those distributions now going forward is going to include a little bit of after tax and a little bit of pre-tax. And the only way to track that is to file Form 8606. Let me qualify and say, not necessarily the only way, it's the common way, but there's a case where somebody said to the IRS, listen, I don't have all these forms, but I have all this paperwork and I can show you proof. And the tax court say, yeah, we'll take it. So as long as you can prove to the IRS how much is pre-tax, how much is after tax, then that helps to prevent double taxation of those after tax amounts.
Now let's keep making the argument for Form 8606, because the IRS advises taxpayers to file it when they make these distributions from their traditional IRA. What is it? What is Form 8606 and why is it important?
Okay, I call Form 8606 the taxpayer's best tool for avoiding double taxation. So you make a non-deductible contribution. You tell your tax preparer, the tax preparer fills out a form that says, okay, this person made a non-deductible contribution. Here is the amount attributed to that. Going forward, you make a conversion, a Roth conversion, or a distribution. The tax preparer takes your most recent Form 8606, add on that transaction to the new Form 8606 and say, okay, based on historical data, here is how much of this distribution is tax-free. Here's how much of this Roth conversion is tax-free. And so now the question becomes, Ivana, well, what if I forgot to file that form in previous years? Then you look at all your forms 5498s. That's what the IRA custodian used to report your contributions. You look at all your 1099-Rs to date, and your tax preparer can now say, okay, you didn't file Form 8606 for 2020, for example. What do we do then? You go back and you prepare the 2020 version of Form 8606, because now you're playing catch up, right? Because the thing with Form 8606, it's a build on form. You can't just say I'm filing it this year, right? It builds on any previous version of the form that you should have filed. So if you should have filed it and you didn't, you got to go back, create that form, build on to the current form, and make sure you file all the missing forms with the IRS so they have the historical data.
So it's not too late.
It's not too late. And a common question I get is, well, Denise, how far back can I go? And I say, don't tell the IRS that I said it, but go as far back as you can. Because you know what? Based on experience, I've seen people file Form 8606 for 10, 12 years, and they were not rejected by the IRS. What is the IRS going to do? Say, okay, you're proving to me that you don't owe me taxes, but I want you to pay me taxes anyway. They're not going to do that, right? They're the kindler, gentler IRS. So
and that's who we need to keep in mind. All right. So what records should people keep track of to ensure that they're not paying income tax on tax-free retirement money?
Right. So keep copies of all your tax returns, right? Sometimes it's hard to get copies from the IRS. You change a tax preparer, they might not have copies. Keep them in a file that's easily accessible, maybe like a Google Drive or on your hard drive to be safer. So keep copies of all your tax returns, keep copies of all your Form 5498s. That is what your custodian uses to report your contributions. Keep copies of all your 1099-Rs, because this is what your tax preparer is going to use to say, okay, in 2020, you made a contribution, but did you take a deduction for it? I don't see it being reported on your tax return as you claiming a deduction. Therefore, we need to file Form 8606 for it. And keep copies of your account statements too. Keep everything for as long as you can so that when you need that history, you can go back and recreate it if needed.
Save. So what's the takeaway to avoid costly mistakes in IRAs?
Yeah, the takeaways, and we're just talking about one of the many mistakes that are often made here, right? The primary reason for saving in IRAs is so that your earnings grow tax deferred and you pay taxes only when you take distributions of those amounts. It's about saving on taxes, and you lose all that benefit if you don't keep track of your after-tax amounts. Now, there are going to be some individuals who don't have after-tax amounts. So they're okay. They don't have an issue with Form 8606. So I'm going to ask you the question, do you, not you, but do you know for sure that you don't have after-tax amounts in your IRAs? And let's talk to the beneficiaries too, Ivana, because here's what happened. Someone inherits an IRA. It's have a huge after-tax balance, but the beneficiary's tax preparer is not the decedent's tax preparer. And they're not transmitting information to each other. So the beneficiary's tax preparer doesn't know to say, oh, so you inherit this traditional IRA. Maybe part of it is non-taxable because the decedent have after-tax amounts. So if you inherit a traditional IRA, make sure you talk to the decedent's tax preparer to find out if they had after-tax amounts. And if you inherited part of an IRA as part of a divorce settlement, that applies to you too, because if you get half of the IRA and that IRA has after-tax amount, you get half of the IRA after-tax balance as well.
So we definitely need to just always talk to the tax preparer of whoever saw this IRA last.
Exactly. And, the tax preparer use what you give them. Mm-hmm. So don't assume that they know. Make sure you tell them about every type of transaction that occurs within your IRA.
Because we're in charge.
Because you're your plan administrator. You're an IRA administrator.
We got a promotion. Thank you, Denise, for these important IRA tips.
You're welcome. Thanks for having me on.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you, and subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor Morningstar. Take care.